Joining me now exclusively on the exchange is Phil Green. He is the chairman and CEO of Cullen/Frost Bankers. Welcome back, Phil. It's good to see you again.
Good to see you, Kelly. Thanks for having me.
Which part of the yield curve matters most to you guys?
You know, for the most immediate impact to us for operating leverage, it's the short end of the curve. You know, we've really positioned ourselves over the last year and a half to take advantage of this. We have going into it, about 30% of our balance sheet was in a checking account at the Federal Reserve, earning about 15 basis points. So we had the maximum optionality for increased interest rates, and it's great that we've been able to see that some. So we've taken advantage of that.
So in other words, do you benefit more from the very steep 3-month 2-year, 3-month 10-year versus the part that I previously mentioned?
Right. It's actually the short end of the curve. It's really what the Fed is doing on the Fed funds rate and the earnings credit rate that they're giving. So that's the biggest impact, because that's what our loans are tied to. We have a tremendous amount of floating rate loans, and that's also what this liquidity is tied to. We'll take advantage of the longer part of the curve with lots of investment capacity, and we'll take a look at the parts of the curve that give the most risk reward in terms of what it gives us, whether that's mortgage backs, municipals, or even Treasury. So we're looking at all those.
If you benefit just from the Fed funds rate, you could be sitting pretty for the next 18 months. We're talking about it going from, 0.4% to 2%, maybe 3%, maybe 3.5%. I guess the flip side of that would be it's happening because we're in an inflationary environment, and we've seen banks have pressure on their expense ratios and other things. So what's your outlook for profitability, even with the benefits that we're talking about?
Yeah. Outlook for profitability is good. You know, every 25 basis point increase in the Fed, our modeling shows that's about 20 to 25 cents per share for our profitability. So those increases would be very significant to us in terms of profitability. But the other thing it does is it gives us the ability to continue to increase rates to our customers, be fair with them. And as we see increases in interest rates, we let them have some of the benefit of that as well, and not wait till it gets a 100 basis point increase like we did and the industry did in 2017. We sort of learned our lessons from that, and we're moving along as rates increase by the Fed.
Oh, interesting. So a little snappier this time. What is happening on the expense side for you?
You know, the biggest increase in expenses is in labor. And I think that's not just true for us, it's true for our customers as well. We saw our minimum wage increase by 33% at the beginning of this year, went from $15 to $20. You're seeing that in so many different areas, and it's affecting many industries.
You're right, exactly. And that offsets, the benefit that you're getting from higher rates is offset to some extent by that pressure. Can you also speak to loan demand, which we all watch as just a gauge of, is the economy still strong and growing quickly or showing signs of moderation? What do you see there?
In the markets where we're still seeing good loan demand. We saw a really good pipeline. We really saw an inflection in commercial and industrial loans back in May and June of last year. That's continued to be consistent, and we haven't seen any drop off in loan demand at this point.
That's great news. What about the consumer, where we hear about, high levels of liquidity, bank accounts, and all the like, but we are lapping the stimulus payments, we are getting back to normal, and we are seeing a huge sting coming from inflation?
Yeah. As far as balances, they are higher than they were pre-COVID. And so a lot of those balances on average are sticky. The part of the economy that we worry about is the impact that inflation has on the less fortunate and on the lower income segment, because that's effectively a tax on them as you see prices for energy, prices for food increase like they have.
Does it mean you guys are Texas-based? Is the region generally benefiting from the activity around the oil and gas industries, or struggling with the hit that every consumer is taking on those prices?
Yeah. I think the industry is really interesting when you look at it right now. Prices are high, but you haven't seen a lot of increase in production. And some of the customers that we've talked to recently say they're restricted in the amount of drilling and the amount of production increases they can come up with, because the inputs are restricted. Sand, for example, downhole production pipe, for example. Truck drivers, labor of all kinds. And so you're seeing one of them told us that it's the first time in their history that they haven't been able to redeploy their cash flow into drilling like they'd like, because they really just don't have the capacity of inputs in order to get it done. And one of the things we've also seen is that lease prices haven't really seen a strong growth at this point, which tells me that you're not seeing a lot of speculation money going into the market there. You're not seeing a lot of capital move into it. So I don't think it's going to be, I think it'll be a while before we see much production increase from the oil patch. And so I don't think it's that big an impact in Texas right now.